Hello and welcome to Lesson 8, Trading Technical Confluences. Confluence is simply an area where two or more factors line up to give you a reason to do something, sometimes referred to a magnitude of evidence that you're stacking one thing on top of another to give you evidence to say go and take this action. And in trading we term that as confluence, where we get a series of points or reasons to say let's look at this area and initiate a trade from that area. For example, say you have horizontal support line and you have an uptrend line. Price is trading above the support area, comes down to a point where it coincides with the support area and the uptrend line. That gives you a confluence of events where you look at analysing the market in a bit more detail and possibly take a long trade. We have several things that we look at when we're talking about confluences. We have chart patterns, key levels, Fibonacci ratios, divergence. And in the chart patterns, for example, we have double tops, double bottoms, triple tops, triple bottoms. We have channels, bullish channel, a bearish channel. We have flat or sideways channels. We have other things such as triangles, wedges, pennants, etc., etc. There's a whole host of commonly used patterns in amongst technical analysis. Wikipedia, this is taken from Wikipedia, where it describes confluence in stock and commodity markets, but basically it can be applied to any instrument. It doesn't matter if, or specifically have to be a stock or commodity. It's any instrument basically, forex, anything that's a liquid market, and by liquid I mean there's plenty of buyers and sellers and transactions behind the scenes. You don't want illiquid markets, as you get sharp and jerky price movements and it's unreliable, as it can just jump from one place to another. In a liquid market things move a little bit more steadily and a little bit more reliably. So let's have a look at some chart patterns. A double top. Generally when we're looking for a double top, we want to have price around the same level and we want to have a time duration in between those two peaks. And this is the actual amount of time will be dependent on what you're looking at, whether you're looking at a daily chart, hourly chart, or a 5-minute chart. So that the actual time in between peaks will be different for each of those time frames. But basically what we're looking at when we look at a chart, regardless of time frame, is we want a period or a duration between the two peaks. So for instance, in this example on the right here, we have quite a lot of bars between top 1 and top 2, so that gives us time duration, a separation from those two levels. And what we can see here is the buyers come in and take it up to a top, sellers sell it back down, buyers come back in again up to top 2, and then the sellers come back in, buyers run out, and price then trades down below. When we're looking at double tops, we look at various factors, whether there's support or resistance, and other things such as a DRF. If we get a DRF bar at a double top, that sort of perks our interest up to go and take a closer look and possibly look for a short trade. Because all these things, when we're talking about confluence, we're looking at gathering more information, more evidence, more points behind our view to say, well, this, with all these factors taken into consideration, it gives us a higher probability that it's going to work out. Like in everything, there's no guarantees, but we're looking for a high probability entry to give us the best chance of taking a successful trade. And if we have a DRF at a double top, that gives us a confluence of events and confidence that we can initiate the short trade. On the example here we have a bearish channel, and when we're looking at a bearish channel we connect the highs and the lows, and we can see we've got a downtrend and then a downtrending channel within that. So the highest probability for success would be initiating a short position at the top of the channel. So when price comes up to the top of the channel, we want to look for factors that will back up our case for initiating a short trade. That's not to say you can't trade from the bottom of the channel, but you just got to realize that you're trading against the trend and against the channel. So you need to have, quite a good argument and a number of points behind you to initiate that trade. And like all good things, channels come to an end. We don't know when that's going to happen, but it will happen, that's guaranteed. And once price breaks out of that channel, then we consider the channel finished and ended and no longer valid. So in this particular case we've got a downtrending bearish channel. If we get a DRF when price is at the top of the channel, then that is one good thing on our side to say, well, the probabilities of initiating a short trade successfully has increased. The other type of channel is a flat or sideways channel. As this graph shows here, price is going up and down and tracking sideways, so it hasn't really gone up to make higher highs and it hasn't gone down to make lower lows. It's just drifted sideways. Now with all channels we're looking to have a reasonable range, and by range that means the number of points. With a small range, say it's 30 or 50 points, price can get through that channel quite quickly and quite easily. If the channel is wider, preferably over 200 points, by the time price gets to the other side of the channel it's starting to get a little bit tired, a little bit exhausted, so therefore the probability increases that we'll get a potential turning point. So, and not only that, it also gives us, when we actually initiate a trade, it gives us plenty of room for that trade to work in. So they're the sort of things. That's why we're looking for 200 plus points on a channel. And if we get a DRF either at the top of a sideways channel or the bottom of a sideways channel, then that's giving us indications that we need to look at this further, as we could potentially have a nice trade setting up. Key levels are basically what we refer to as high level time frame points of interest, either for support or resistance. When you draw support and resistance, if you're drawing them on a 5-minute or a 15-minute chart, while those levels are valid, they're not as strong, anywhere near as strong as a daily or a weekly level. So we refer to key levels that are drawn from the higher time frames, such as daily or weekly, where there's plenty of strength behind them, so the probability of a turning point occurring is much higher. As with anything, it's up to you and your own trading what you use, what time frame you use, but just remember that the higher the time frame, the stronger that level will be. Now we mark these key levels up on our chart, and if we get other factors around that area, then that makes us look at that level further to see if we can initiate a trade. And for example, if we get a DRF of one of these particular levels, then that could give us a good indication that we're going to initiate a trade. And on this example here, there's a couple of DRFs that came up to that support level, entered the short trade, and they worked out quite nicely. So they're the sorts of things. So that's a confluence of events at a key level. On this chart here, it shows we have a support level horizontally and an uptrending trend line. Where these two lines meet is a point of interest, and as price comes down to that area, in this particular case it formed a DRF, which again improves our chances, makes us look closer at this particular price level, and we're looking to initiate a long trade. So these are the sorts of things. You've got a confluence of events, a support line and an uptrending line, and then with a DRF candle we're looking to go long. The golden ratio is referred to as the 0.618 and 1618 Fibonacci retracement and extension levels. Fibonacci is a price series, and it's a quite a interesting topic to go into. I won't go into it too much here, but it's, if you Google it, you can find out heaps of information on it, and it's basically, it's not just related to charts, it's throughout nature, it's throughout everything that these Fibonacci numbers, ratios, all coincide, and it's quite an interesting subject, so I encourage you to go and have a look at that. In charting, we normally use a Fibonacci retracement or extension tool, and we're looking for the Fibonacci levels to coincide with other factors to give us areas of interest where we may initiate a trade. For example, price retraces to the 618 level and gives us a DRF, then that again makes us interested in that level, and we'll look to initiate a trade from there. And if price does retrace to the 618 level and reverse, then we'll look to trade that to the 1618 extension level. So not only does it give us areas of entries, but it also gives us targets for our trade. So it's very, very handy. The last thing we'll talk about today is divergence, and divergence is the difference between what's happening on the price chart and what's happening on an indicator, and specifically an oscillator. And by oscillator I mean things such as the MACD, stochastics, RSI, they're all in the oscillator subset of indicators. In our case we look at MACD and we use the standard settings. So what we're looking for, as this example here shows, is we're looking at two troughs on the price chart, and we've connected those with a downtrend line, and then we take those troughs and go down to the oscillator and see where the oscillator lows are. And in this particular case, the oscillator has made two lows that are joined by a horizontal line. Sometimes it'll be horizontal and sometimes it'll be pointing up, so you basically got a divergence or difference in opinion between what's happening on the price chart and what's happening on the oscillator. The price has gone lower on the price chart, but it's level or going higher on the oscillator. So that gives us a point of interest to look at to see if we can get confluence of events to initiate a trade. And if we get a DRF at a point of divergence, then that piques our interest and we're looking to initiate a trade if we get other factors stacking up. The example here is an example of bullish divergence. For bearish divergence, it's simply the reverse. We're looking at the peaks. So on the price chart you would get a higher peak, and then when you come down to the oscillator below, you'll get either a level or lower peak. So price is trying to go higher on the price chart and the values on the oscillator are going lower, so it shows a potential turning point. That's basically it for this lesson, so we'll end here. Thank you.